Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we welcome back Kevin Davey for another webinar. Today the webinar is going to be for both discretionary as well as automated traders, and the topic is testing for success. Some of the bullet points that Kevin wants to cover today include why all traders should be continuously testing their approach, why many discretionary traders avoid testing altogether, how every trader should be testing, how to know if you're testing enough, what to do after you test, and what is a test library and why is it important. Also, at the end of the webinar today, we're going to be giving away 5 autographed copies of Kevin's new book titled Building Winning Algorithmic Trading Systems. Pay attention to the content covered in the webinar because there's going to be a quiz, and that is how we will give away the 5 autographed books. In order to win one of those books, you do need to have a username on BMT. So if you came here from Kevin and don't have a username, you can go to bigmiketrading.com and register a username real quick, because that is how I will get in touch with you in order to get the information to get the book into your hands. The webinar is being recorded like always. I'll post the recording on YouTube sometime tomorrow. If you're watching the recording at a later date and you like it, please do me a favor and give us a thumbs up. Kevin has asked that we hold the questions until the end of the presentation. So without any further delay, let's get started. Okay, Kevin, so I have now given you control. You should see the option to share your screen.
Okay.
Okay, we've got it.
Perfect. All right. Well, hey, thanks, Big Mike, and welcome, everybody. I'm glad you could join me today. And today I'm going to be talking about testing for success. It's something I think a lot of people don't do or do incorrectly, and so hopefully we'll be able to learn a little bit today. So first, for those of you who don't know me or aren't familiar, right now I'm in Cleveland, Ohio, and that's where I live. And you can see up near Lake Erie that big orange dot at the top of the map. And there's a view outside my house today. I took a picture a couple hours ago, so it's a little bit cold today. So hopefully it's warmer where you are. 71 degrees in July in Ohio is really kind of unseasonable. So, but anyhow, what I'm going to do first is just kind of go through my background a little bit, just for those of you who don't know me, and then I'll get into testing for success. Then we'll have some time for questions and answers. We should have quite a bit of time for that. And then at the very end, we'll have a short quiz and do a book giveaway. And Wiley Finance, who's the publisher of my book, was kind enough to give us 5 copies to raffle off. So I just wanted to give them a little plug because they did provide these books. Okay, you saw this disclaimer or similar one right at the beginning of as you were waiting for the webinar to start, and I won't go through everything in here, but just remember that futures options trading is risky, and don't afford to trade with money you cannot, you don't want to lose, you can't lose. So there's a lot of good information in this disclaimer. All right, so me, what about me? Well, I'm a full-time trader, and 3 years straight I was first or second place in the World Cup Championship of Futures Trading. And each of those years I had over 100% return, and that's with real money. And you might have heard of that contest. That was the one back, I think, in the 80s that Larry Williams turned $10,000 into over $1 million in the course of a year. So you had a lot of high-powered traders, some really good traders who entered that contest, and I was fortunate enough to finish first or second 3 years in a row. So that's some of my background, and actually doing that well in a contest against a lot of professional traders was part of what convinced me to go full-time, and I've been doing this full-time now for about 6 years. You might also recognize my name from the Battle of the Bots thread that's on Big Mike Trading. I've kind of taken over a facilitator role in that, and kind of getting bots together and running the contest. And so we're just about to start another one in August, and we do one every month. So if you have some kind of strategy you want to submit, do so. You get a little prize, and most of all, it's really bragging rights is what you get. So it's pretty cool. And by the way, if you happen to be a good person with Ninja, I posted a question on that thread earlier today, so maybe you'd be able to give me a little assistance, because I'm not a real Ninja person yet. Okay, so Mike had mentioned my trading book. It just came out about a week ago, and it's both a paper and Kindle edition. And this is the book we're going to be giving away 5 autographed copies at the end. And it pretty much walks through my trading history and also how I test and how I evaluate systems. So it's, I think it's a pretty good book, but of course I wrote it, so of course I think it's pretty good. So what about my trading style? You know, here's my book on algorithmic trading. So that's primarily what I do. It's, you know, it's all these rule-based kind of algorithmic approaches, mechanical rules, you know, things you can completely define and test. I also do some option selling of futures, and that's pretty much rule-based too. Can't really test it the same way you could just as straight-out algorithm, just because of the nature of futures options. And there's a thread on Big Mike that Ron99 put together or started that talks about this futures option selling. So if you're into that, I'd go check that out. And then I also do a little bit, not a whole lot, but I do some discretionary longer term, what I would call like macro investing. So for example, right now, some research I've done says the Japanese yen should be coming down in the long term. So I'm short the yen. That's kind of an example of that. But in all the things I do, my big thing is I always try to test and evaluate. I try to make any kind of trading decisions I can just based on data, based on facts, you know, based on what's there. I try not to see something in a book or a magazine and get all excited about what somebody shows, you know, a chart with a nice equity curve. I try to test it and verify it, you know, and figure out for myself. I definitely don't let emotions get in there. And the flip side to that is if it can't really be tested, I'm not really trading it. I don't want to trade it. I can only trade things that I can test. And so that's the way I kind of approach it. So here's a good statement that kind of summarizes my approach. This is from a book. It's a Kindle book. Actually, it's a really inexpensive Kindle book on Amazon that I came across a couple weeks ago. And you know, sometimes those real inexpensive books on Amazon are really bad, but this one just kind of blew me away because this is a really good book. And what it says is you need rules to test your strategy. And you know, the author's point here is there's a lot of smart people out there who are trading. You know, the PhDs, physicists, statisticians, mathematicians, and they're taking and a lot of times they're taking the other side of your trade. And you got to wonder, do they know more? Have they tested more? Have they evaluated more than you? Or do you somehow have a leg up on them? And a lot of times if you don't know, the answer is probably that you don't have a leg up on them. You know, it's the old joke, if you're playing poker with a bunch of people and you can't figure out who the sucker at the table is, chances are it's probably you. So testing can help you not to be a sucker. It's kind of the way I look at it. So I'll give you a couple simple examples, because some people still think, hey, I don't need to test. Let's say you're trading and some event A occurs, whatever that is. It could be a price, some kind of price action, some kind of candlestick, some kind of crossing of moving averages, some kind of oversold region, whatever. And then let's say you looked back and saw every time that occurred, and you found out that another event, maybe a price drop, maybe a price gain, but something occurred 75% of the time when that first event occurred. Don't you think that would be great information to have? I mean, I certainly do. The alternative to that is that event still happens, that candlestick or whatever still occurs, but then you have no idea if that leads to anything normally or not. You're basically flying blind, and that's not good. Another way to look at it is, we all drive in traffic, and we all expect when we hit a red light, we stop, and when we're going through a green light, we expect the people who have the red light to stop. And think about how tough life would be if every green light you went through, you had to be sure that the people who were stopped at the red light were actually stopped and weren't just going to blow through the red light. It's not certain that, and this picture is a good example, not everybody stops at red lights, and that can give you some problems. That's why people get in accidents. But the big thing is, if you know something is going to occur with probability, you can probably say, hey, I'm coming up to an intersection, I have the green light, I'm 99% certain that nobody's going to go through that red light. It makes a lot easier to go through than if you said, oh, I'm 1% certain somebody's going to run that red light. So that's kind of why we do testing, is you want to find things in the market, you want to evaluate certain circumstances, certain occurrences, whatever, and you want to evaluate if they lead to something. And by leading to something, you could create some kind of edge to build a trading system around. So, for algorithmic traders, people who define their rules completely, I think it's pretty easy. You create your rules, you plug them in your trading software. I use TradeStation. Ninja's a great tool, multi-charts. There's a ton of them. You just put the rules in there, you run it, you evaluate the results, and then you make some kind of decisions on it. Yes, I like this equity curve. No, I don't like this trading system. The losses are too big. But the point is, you've made a pretty nice evaluation, and it's based on hard facts. So you're going to make a decision based on the data. You're not going to make a decision that says, well, hey, I really like this system because it feels good. No, you're going to make a decision that, hey, I'm going to trade it because it makes money, or I'm not going to trade it because it loses money. And when you're an algorithmic trader, that's really, to me, part of the whole allure of algorithmic trading is that you can define things. And especially if you're more of a mathematical type person and you like numbers, that's a great way to test and evaluate. Just put it in an algorithm. On the other hand, if you're a discretionary trader, it is tougher, and I don't think it's impossible though. And because what I hear a lot of times from discretionary traders is that their method, whatever it is, cannot be tested. And for the most part, I kind of think that's just junk. I don't believe that, and I'll get into it, the reasons why in a little bit. But to just paint this broad stroke and say, hey, I have a method, it can't be tested, I'm not even going to bother and just go on with life. I don't know many successful discretionary traders who act like that. So, the question is it maybe just an excuse for something? Maybe it's true. So we'll get into that in a second. A lot of gurus out there, a lot of these discretionary gurus, they love saying this. These are a lot of people running trading rooms, and also some people selling books that, have this just obscure method with, I don't know, Fibonacci numbers, price action, whatever, Elliott wave, it doesn't matter. But the gurus, so-called gurus, and I say so-called because a lot of times what they'll do is they'll put on this real impressive front of how their method is great, but when you go to try to test it, they'll either tell you that it can't be tested, or if you do test it somehow, they'll tell you you tested it wrong, that you didn't get all the rules, that there's so many rules in their head that can't do it. To me, I think a lot of what those guys are doing are that they're just hiding behind the fact that they don't have a method, that their method, or that worse, that their method is just garbage. And I would bet you probably 9 out of 10 trading rooms are like that. They're just garbage. And these gurus are hiding behind it, saying they can't be tested, blah, blah, blah. Hey, it keeps their business going. I wouldn't want to run any kind of trading room where it was proven that my method failed time and time again. So that's just, I guess that's probably my opinion a little bit, and I'm kind of a little bit of soapbox, but as you can tell, these people who pretend to be something they're not just kind of, and take advantage of traders, just kind of upset me. I guess that's the nice word. Okay, so say my method cannot be tested. So that's what discretionary traders do. I found this feature on Google Translate. Well, not really, but if you could take the language of trader speak, which is my method cannot be tested, and you translated it into reality, when somebody says my method can't be tested, what are they really saying? And there's probably a lot of different answers, but I came up with 4. Some people say, hey, I don't know how to, what they're really telling you is, I don't know how to test. I don't know how to test this discretionary method I'm doing. They could be saying, I don't know the math, I don't know the statistics behind it, so I could test it, but I don't know what in the world I'm doing. Somebody else says, you know what, when it really comes down to it, they can't test it because they don't even have a method. They're just guessing. And they think they have a method because, they have a bunch of Fibonacci lines and support and resistance and some trend lines on a chart, and they think that's a method, but the way they apply it, there's really no rhyme or reason to it. And that could be the reason, and they just don't want to admit it to themselves that they're just guessing. And the last one is that they don't want to know the results. And I think that is true for a lot of discretionary traders. Their trading's going bad, but hey, I don't want to know. I don't want to test and prove that my method doesn't work. I'd rather go on saying, oh, it's my psychology, I got to work on myself, I got to keep a journal, all this other stuff. But in the end, all the psychology in the world, all the journaling in the world isn't going to help you if you don't have a method that has some kind of record of success. So let's talk about each one of those in a little detail. So here, I don't want to know the real results. And again, that's just this fear that your method is bogus. Let's say you found a book, a trading book, it's 300 pages, a big book, and you went cover to cover with it, and you studied it, and then you found out that this guru had some kind of trade advisory service or something, and you followed it, and you invested all this time and effort into it, and you started trading it live, and you're still losing money, you'd probably be kind of upset. And maybe in the back of your head you're thinking, yeah, maybe this method is just bogus. Maybe there's nothing to it. But that's a fear that you'd have to overcome to actually go and test it. And a lot of people are more comfortable just saying, I can't test that method, and leave it at that. And again, if there's a guru behind it, somebody with a trading room or something, we all know how they hide behind results, and it's hard to get any kind of answers out of those kind of people. So that's one reason people don't want to test. Then the defined method, you're just guessing. That's probably no way to go through life. I'll talk about an example of driving your car a little later, but think about if you were going somewhere you've never been before, and you just got in your car and you just started guessing, right turn here, left turn here. I'm going to go for a mile straight. If you just guess, maybe you'll make it to your destination. Maybe you'll make it into the worst part of town. Who knows? But the point is, you really have to have some kind of method. Hey, I'm going to follow a map. I'm going to look at my GPS kind of thing. Now, even if you don't have a method, and even if you can admit to yourself that you're just a discretionary trader that just guesses, so maybe your approach is you turn on CNBC in the morning and you see some talking heads talk about a stock, and then maybe you pull up a chart, and depending whether you are looking at a candlestick chart today or a line chart or maybe a point and figure chart, you'll make some kind of snap decision to buy or sell or whatever. Okay, it's not really a method you can evaluate in the past, but what you could do, you could still evaluate if that's working. Just you keep your results day by day, and then at the end of a month or so, hey, are you doing, did you make profits that month? Well, if you did, that's saying maybe your guessing method, maybe it works. I think you'd have to do it a lot longer than 1 month, because there's a whole host of other ideas that would come into play with that kind of method. But again, the point is, look at your performance and go and test it and evaluate it and see if it makes sense. All right, so another testing excuse. I don't know how to test. I don't know the math. I don't know the statistics. We're going to get into some of that later. But, the real point with that is, maybe it's time to learn. Maybe it's time to drop this, hey, I hate math kind of thing, and I'm never going to be able to figure this out, and get down and learn it. You don't have to have a PhD in statistics to evaluate candlestick patterns, for example. You can run some simple tests and do a simple process and get some pretty good results that you can rely on, and that's all you have to do. I know statistics is pretty complicated, and a lot of times it's counterintuitive, the way you approach problems and do things, but it's also a great way to put some, I guess, definitiveness behind what you're doing. And just to say you don't know how and you don't want to learn, you know what, there's people, I guarantee you there's discretionary traders who took the time to learn and are probably doing a lot better because they did. So make an excuse like that, I don't think really is going to work with the market. The market isn't going to reward people who don't put the time and effort in. So, like I said, algorithmic testing is definitely easier to do than discretionary, but regardless of what you do, however you trade, you got to do some kind of testing. You got to do some kind of evaluation of what you're doing on an ongoing basis. Whether or not you go way back historically, we'll talk about some of that. You want to test. It's always a good thing to do. It's better to test and know than to not test and be unsure. So the way I'm looking at it, and this is more towards the discretionary traders, but a lot of the principles also hold for any kind of mechanical or algorithmic type person. First thing you want to do is test however you can. Then you want to test whatever you can. And you got to make sure you test with enough data to make some kind of rational decision. And then the two last things are part of this, I guess, like a feedback loop, if you think about it, where you get information. It's up to you to make some kind of decision based on them. So one, you got to be able to listen to the results, and two, you got to be prepared to change what you're doing based on the results. So it does you no good to test doji candlesticks if you're just going to ignore the results because somebody else tells you that what you found is not right. If you find some guru who says, hey, doji bars are the way to go, and you test it and find it's not, you got to listen to the results. When you test it right, you can listen to the results more than you can listen to any person. Okay, so first, test however you can. That's one of the keys. So a lot of this will probably be common knowledge to you, hopefully, if you've done any kind of testing. You can look at it a couple different ways. One, you can look at what you're testing, and two, how you're testing it. So you can do historical testing, where you go back and run these back tests. You can do real-time testing, and you can also do this market replay, which is the pseudo real-time. So it's supposed to mimic real-time without it being real-time. And you can trade on paper and record all your trades. You can use a sim account. You can use real money. So we're going to kind of talk about next few minutes, talk about some of the combinations of all that, because some of them you want to avoid, and some of them might be pretty good. So in the whole historical real-time market replay, okay, what's good, what's not? Well, I'd start out with good with just historical testing, where you have all this past data and you run a back test. That's what I would consider good. It's certainly better than doing nothing. Better, I think, is doing a market replay, especially if you're discretionary trading where you have to make a decision on each bar. I think that's kind of a nice way to do it because you can't see future bars with it. So that's kind of a neat tool. The best, obviously, is doing it in real time because the problem with market replay is, let's just say you decide to do your market replay at night after the market's closed for that day's action. Well, if you were sitting around your computer during the day or you heard news, maybe the stock market fell at some point during the day. Well, then when you go to run your market replay, even though you tell yourself you don't know when it happened, you still know the market dropped at some point during the day. So all your trades are going to be tainted by that. Maybe just a little bit, but they're going to be tainted. And you might make some decisions you wouldn't have normally made had you not known what was going to happen. And that's a real common thing for people to do. They think by using something like market replay or even historical testing that they're going to ignore the results, but the reality is they've kind of generated their rules knowing some of that past history. So real time is a good way to go. And then obviously the ultimate best way, but there are drawbacks to it, which we'll talk about, real time with real money. I mean, obviously you cannot beat that for being a way to prove a method. But like I said, there are some drawbacks to it. And then if you look at this whole paper sim real money, you know, doing paper trading where you maybe look at a chart and record the trades, put them in a spreadsheet, whatever, that's a pretty good way to do it if you do it right. A little bit better are the sim and demo accounts because they hold you a little more responsible where you know, you can't go back and erase a trade unless you like zero out or reset your sim account. I don't give them a super grade only because there's always flaws with the simulator. It's not the real market. And obviously the best is real money. I mean, you're testing something with real money, that's the way to go. But it doesn't mean the other ways can't work for you. So here's an example. A lot of people don't want to do real-time, real money for some of the reasons we'll go over in a little bit. But so that what they do is they do this paper trading historical testing, and they think once they do it that everything's going to work out. You know, that their paper results will translate into real life. Well, I want to give you an example because I came across this book. This is another Kindle book. It's a different one than I talked about earlier, and it was really highly rated on Amazon. It's 4.6 out of 5 stars. So you know that's a pretty. That would suggest to me people think this is a pretty good book. So I'm putting it in this guru status. And you probably can realize where this is going because every time I've mentioned guru up to this point, it's been pretty negative. But, okay, here's this guru method and a guru trade. So what this person's doing is trading trend lines. And this is right out of the Kindle book. And you can see they enter when the price comes up and touches that upper trend line, and then they exit down towards the bottom where it hits the bottom trend line. So, hey, that looks good. Man, that's a nice paper trade, great entry, and a great exit. Well, maybe not. Let's take a look at this a little bit. Okay, well, the first thing is this particular example used what I call hindsight bias. So it knew what was going to happen before it happened. So what do I mean by that? So let's look at this upper trend line. And you can see that it's entering when it comes close to touching that upper trend line. So that's the trigger, that's the rule that this guru came up with. Well, the problem with that is, how did they draw that trend line before that data was there? So, for example, go back a few bars from this, and you'll see, hey, I would have drawn the trend line maybe as this red line because this went up to the green. And you can keep stepping over, and the point is, you couldn't draw that trend line and enter the trade at the same time because you didn't know when that trend line, or when that correction, you didn't know when the correction that's circled was going to end. So you didn't know where to draw that upper trend line until it was already done. So there's no way you could have traded it. So that's mistake number one. Mistake number two is they completely cheated on the whole entry. Their approach said, hey, when it touches the trend line, you sell. Okay, well, you can see there, I can see, it's pretty easy. It didn't even touch that trend line. So one, the trend line's fake. They could have never drawn it in real time. And two, it never even touched. So right there, that's just garbage entry. I mean, they just made it up. Okay. So that's mistake number two. Mistake number three. Let's take a look at that lower trend line. Okay. Well, if you look at that gray line, that's the one out of the book. They kind of touch the bottom, and then where I have that blue arrow, they just kind of eyeballed it and didn't really draw it across the bottom Mind you, that was their rule, that you connect lows. So if you connect lows, you got to connect lows. You don't connect above the low. So they didn't connect the low. And again, it's the same hindsight thing. You didn't know where that line was until it actually occurred. Well, in this case, it would be okay, but the red line is more where you should have been. Okay, so you look at it, you're doing your paper trading, and you say, well, okay, I drew the trend line a little bit off. That's not going to matter. Maybe. Here's mistake number 4. They cheated on the exit. So there's their nice gray line, and they said when it touches the gray line, that's your limit target. Okay, well, hey, never touched. And yet they exited with a profit. So they cheated on that. And so they cheated on their trend line, which was wrong. And look at the red line, which is the line I drew, which should have been the trend line. They were nowhere near it. So basically, not only did they cheat with what they drew, if they had drawn the trend line correctly, they would have been nowhere near an exit. And probably over the long run, if the price continued out, they would have lost money on this trade. So here you go. Here's a paper trade. This is supposedly an expert. If you can go off Kindle recommendations, which normally they're pretty good. It's all BS. It's all fake. Incorrect trend line. Incorrect lower trend line. So an upper trend line's wrong. Lower trend line's wrong. They entered improperly. They exited improperly, which I call phantom exit because it really wasn't even, they could have picked any point and just drawn a line and pretended, close enough, hey, that's your guru. That's your guru for you. That's your discretionary guru. That's really, saying how great his method is, and yet he can't even give you an example that he follows. So the lesson here is just be super critical whenever you do, if you do any kind of paper trading, any kind of chart analysis like this, you got to be rigorous. And if you're not, you're really only fooling yourself, because if you're not rigorous in how you do things, when you go live with whatever method, the market is going to tell you that you're not doing things right. And that especially holds true, if it's a guru that you're following or not. Whatever method you're following, if you're not strict about what you're doing, if you kind of, just draw a trend line wherever, man, you're never going to be able to have any kind of consistent results because you're not being consistent in your application of your method. So the big thing too, the kind of second lesson here is make sure anybody you're following just in a discretionary basis, make sure you're testing and evaluating what they're saying and what they're doing. Don't let them slide, because you'll probably save a lot of money if you test what they're doing. I mean, certainly in this case with this book, practically everything I read after that, I knew, hey, that's what this person just doesn't care about the truth. So why should I believe anything they're saying? All right, so that was just an example of some a good way to test if you do it right. Historical testing on paper, and it certainly can be if you're rigorous about it. The best is doing it real time, real money. You can't do better than that. The problem with it for a discretionary trader, it takes a long time to get enough statistics to draw any kind of conclusion. And if you're testing on the fly, chances are you're going to keep changing your method because you're losing, and you're going to keep losing until you find a good method, and that could take a while. That could be an expensive test. That could take you years before you settle on a method that's consistently profitable. Now, granted, once you find it, doing it that method, assuming it works, keeps working going forward, that's a great way to get there, but it might cost you a whole lot in these loser methods that you test live with real money that you find out don't work. So that's kind of the problem with it. So many people, what they'll do is they'll, instead of putting money on the line, is they'll attempt to do something real time with no money. And I guess a lot of trading rooms would kind of fall into this, where you think you're following somebody in real time, you just don't have money on the line and you're trying to evaluate it. Again, with discretionary, you're ignoring the impact of money, because the psychology of money will affect some of your trading decisions, even though you don't want to admit that. And again, the statistics are just slow in arriving, and the big thing that comes up there is people get impatient waiting. You don't want to wait for even 30 or 50 trades with a trendline break method. And after 10, if you're losing money, most people will jump and go to something else. And so what you end up doing is you're just jumping from method to method to method, never evaluating any particular method, and never finding out if something really works. So, it would kind of be if you were dating and you were on the dating scene and you would do a single date with somebody, and as soon as they said something you didn't like or disagreed with, you cut off all contact with them and moved on to the next person and just kept doing that. Well, and it's going to be really tough to find somebody to be with when you just keep rejecting people right at the beginning. And that's the way it is with trading methods. There's no trading method that's perfect by any means. And if you think you're going to find one that's perfect, you're just going to be chasing around, searching in vain for a long time. I mean, it's much better to settle on a method and thoroughly evaluate it, whether it's historical, real-time, whatever. But again, it's testing. You want to test it. And then if you test it and you run enough tests and the method doesn't work, okay, well, hey, it would be like dating somebody and you finally come to the realization after a month that, nope, don't want to be around this person. Okay, well, hey, that's nothing wrong with that. You've given it a good amount of time. With trading, you have to do a certain number of trades at least. I'd say a minimum of 30 before you can make any kind of determination. So, for all those reasons, I don't really recommend you do your testing and evaluation in real time or with real money. It's just, I think it's too hard. I actually do know a trader who does that, and he and I have had some conversations because he knows I'm big into back testing and all this algorithmic walk forward testing, blah, blah, blah. And I asked him how he tests, and he said, well, he comes up with a method and goes live with it. And if it works in real time, he keeps trading it. If it doesn't, he just drops it. Now, I think part of his success is he's been around enough that he comes up with good ideas to start with. And then second, he doesn't put all his eggs in that basket. He's just allocating maybe a little bit of money to a new system, trading it, seeing how it works, let it prove itself, which is probably a good way to do it. Unfortunately, most people can't do that because they can only normally afford one method, especially starting out. And the other part is they don't have the patience to go through with the test, and he knows exactly how long he has to test and what he needs to feel comfortable. So it can work for most people. I would not recommend it though. Okay, so that's testing however you can. What do I mean by testing whatever you can? And this might be a key point for some of the people who say, hey, I have a discretionary method that I cannot test. What you want to do is obviously you want to try to test your whole system as one piece. Okay, that might be tough. Certainly if there's rules that come up once in a while kind of thing. That can be tough. But entries and exits, you can break them down and turn complex entries into simpler entries. There's a lot of things you can do breaking these things up into pieces where you can test them. So what do I mean by that? Well, okay, here's a good example of something I'll call discretionary, because a lot of people will kind of use this as a basis for what they're doing, kind of a candlestick thing. So you see a hanging man candlestick, and there's this bearish confirmation bar, whatever that means, and then you sell below it. Okay, so that's your entry. And you could say, hey, I can't test that. Well, I think you can. And when you look at it as a whole, it looks pretty complicated. How do you put a hanging man into language a computer can read? Or how do you define it so even you know what a hanging man is and isn't, kind of thing. And that's probably the key, is look at what you're doing and try to be as exact as possible in how it's defined. So a hanging man, at some point, that red box, it keeps growing. Let's just say it keeps growing and growing and growing. At some point, it goes from being what's called a hanging man to something else, which is not a hanging man. So there's a point. Everybody might have a different point, but there's usually a point. And that's the idea, is you try to define it, try to nail it down to something specific, where you could look at 10 of these things and say, this is a hanging man, this is a hanging man, nope, that one's not, that one's not, next three are, next one's not. That's what you want to be able to do, because think of just the power in doing that. If you get to the point where you can look at a chart and say this is a hanging man and isn't, and however you determine that, you've put down into a rule and you've tested, wow, that's pretty cool. Because you might know in the back of your head is, when I see what I define as a hanging man, 80% of the time the market goes down the next 5 bars. Boy, when you have something like that, that's where you get your power in it, in testing, is you'll have confidence that, hey, not every hanging man is going to work, but maybe 80% of them do. Maybe it's 70%. I don't know. But the point is, you will have some data, some statistics, some conclusions to back up whatever you're thinking, and you're not just guessing. And there's a ton of power in doing that. So, I mean, in this case, you'd have to define what a hanging man is and what it isn't. You'd have to define what you mean by a bearish confirmation bar. Does it have to be an inside bar like this one's shown, or what exactly? And then you'd have to define your entry point. Do you sell at the market on the close of that bearish confirmation bar, or do you sell on a stop at the low, or maybe some kind of limit order above the close of that bearish confirmation bar? I mean, it doesn't matter. What matters is you define whatever you're doing. Then you go and search for it. And by searching for it, you can go through charts. You can have your computer software, if you've programmed these things in there, to go through it. So here's an example with just that first part, the hanging man. Okay, so I just found this example somewhere. I don't know, just an internet search. And it said, well, a hanging man is a tail that's 2 times the length of the body. Okay, so if the tail's 1 times the length of the body, it's not a hanging man. If it's 1.5, no. If it's 1.99999, for the purposes of testing, you'd have to say no. If it's 2 or higher, then that's a hanging man. So that's what you want to do. You want to make it rigid. And Another reason to make it rigid, you know, I mentioned 1.99 versus 2, and you could say, ah, it's close enough. Well, you know, I'll go back to that book example I showed you with the trend lines. Close enough, just draw the trend line. Yeah, price almost touched the trend line. I would have taken that. Whew, that's just a recipe for disaster. You know, who are you kidding? Chances are you'd take every trade that worked out, and the ones that didn't work out, oh, that wasn't close enough to the trend lines. I wouldn't have taken that trade. I see it all the time. People do that. They just kid themselves. And they kid themselves right up until the time when they do it with real money, and then the market, can't kid the market. You can't fool it. So, again, you want to define it, and that's the way to do it. So, what have I just done? I've taken what seems to be a fairly complicated entry pattern, and I've just broken it up into 3 little pieces. The pattern, you know, the candlestick pattern, this confirmation bar pattern, and then the point where you'd enter, you know, and the type of entry you do, your entry condition. All those are easily testable, and you can test them by themselves. You can test them together. And you can see, is this a good signal or not? Is the hanging man with the bearish confirmation, the bar after, a good signal or not? You know, I'm not giving you the answer here because I don't know it, but my point is you'd have to test it to find out. And if you don't test it and you still want to trade it, to me that's just crazy, because there's no reason why, you know, this should be any better than anything else, any other kind of pattern. So here's another example, and you know, I'll just a simple one with the trend line break. Again, you know, you draw your trend lines however you draw them, and then you determine how you're going to enter. Are you going to enter on a close below the trend line, if it touches the trend line, if it penetrates it, whatever. And you know, maybe there's some other kind of thing in there that you're looking at the macro picture of, you know, if this is in a long-term downtrend for the last year, if you're using daily bars, for example. That might be part of your test. Maybe it's not. You know, again, that's just something you can decide, and you can do it, but you can easily test it. And it's not that hard to spend some time, especially if you can computerize it, but even doing it by hand. If you do it correctly, you can draw trend lines, and you can find multiple examples of this exact pattern, and you can test it and tell yourself whether or not it makes any sense. And unfortunately, most people never take that step, and they just won't do that test. And again, you know, you're just, if you're one of those people who's not going to do the testing, my guess is you're going to be one of the people who loses money in the market. I can almost guarantee it. Here's just a real quick third example of just, you know, a lot of people love to move stops to break even. A lot of discretionary people, you know, they'll trade 2 contracts, and maybe one they'll let be a runner, and one they'll put a break even, you know, because they don't want to lose money or whatever. Is this better in the long run? Yeah, I have my own opinion, but I've tested it. So I know from my kind of systems if moving a stop to break even is good or not. Might be good for what you're doing, might not be good. Again, if you don't know, you test it, and you come to a conclusion, and then you do it. You do whatever it says. So I was surprised to see this quote, and I'm not sure if this is really a real quote by Albert Einstein, but if you saw it on the internet, it's got to be true, right? So that's why I put it up there. But he talks about intuition, and because a lot of discretionary traders tend to, when all else fails, break out that intuition card and say, well, I'm using my intuition to trade, and I can't test. My response to that is, one, you can test components and pieces. So we've already gone through that. You can't tell me you can't test candlestick patterns, because you can. Your intuition, okay, maybe you can't test it, except you can look at it after the fact and it'll tell you if your intuition was good or bad. So you're doing a test, you're just doing it after the fact. And that's a great way to see. So people who say they can't test their method, you should still be evaluating your method after you trade it, and evaluate those results as if you're doing a test, and that will tell you if what you're doing makes any sense. So my opinion is just about everything, one way or another, everything in trading, if you're an algo trader, if you're a discretionary trader, it can be tested. And the other point is just beware of things you can't test. If there's something that there's no way, I mean, I'm sure there's something you cannot test. Beware of those things, because when you can't test it, you can't evaluate it, and when you can't evaluate it, it's hard to make any kind of decisions if it's good or not. Okay, so that's however and whatever. Well, what about testing with enough data to make a decision? This is a real key, and this is where I'm going to kind of skirt around some of the statistics, only because I don't want everybody just to lose focus, because statistics is just a killer. But let's give you some talking points about it. For anything you test, and again, like we said, you can probably test just about everything. You want to have 30 to 50 or more instances before you make any kind of decision. 30 is based on some statistical rule. I'm not even sure which one, and I'm sure you've seen it before. They say, hey, you need 30 trades. Okay, the more the better. So if you can do 100 trades, I would certainly do 100 trades, because 30 trades or 30 instances of any kind of thing in the market is not a lot of data. If you think about like doing something on, let's say, minute bars, you might get 30 cases of something happening in a day, and maybe today was it was an FOMC day, so maybe that influenced those bars or that pattern today, but maybe a week ago it was something different. That's why you want to get, the more cases you get, the better. But the other key to that is, however many cases you get, make sure they're good cases, and I'll go through a couple examples real quick. But you can't pick and choose what you want, and people do it all the time. I know I do it. Anytime I looked at any kind of discretionary method, I was guilty of that, and I knew it at the time, and I still did it. So you got to make sure the cases are good, that you don't do what's called cherry picking. You just pick the ones you want, or where you're overlooking cases you don't want to do. You come up with some reason, and you don't want to use what's called hindsight bias. Here's an example. This is actually just your standard head and shoulders pattern. So, the traditional way to enter is, once the low is hit, you're going to sell below this low of this head and shoulders, because it's tried to make a high at the head, and then it came back and tried to make it at that right shoulder, could not do it. So this is a good sell signal. So if you were looking at a chart and this is all you saw, and you said, I'm going to go short there, okay, I can buy that, because you're not peeking at any data ahead of it. That's where you get into trouble, and that's where most people get into trouble when they're looking at charts, because what they'll see is the whole rest of the chart. Then you can see there's my sell signal right below that line, and you can see what happened afterwards. It was a bad signal. That happens. So the market took off. It not only did it not go in the direction that a standard head and shoulders would have said, it went the opposite way and just took off to new highs. So it failed. Now, if you were looking at this whole chart, what you see here, one, it might even be hard to pick up the head and shoulder pattern because now it's buried in this kind of trading range behavior on the chart because the chart scale is different with those new highs. But the other thing is you know what's going to happen. So what's your inclination? Your inclination is going to be that that wasn't a good signal. If you're doing your paper testing, you would have probably come up with some kind of reason why you would not have taken that trade. You know, ooh, it looks like it barely poked through that line, horizontal line. That wasn't a good signal. No confirmation, so I wouldn't have taken it. All you're doing is using hindsight bias. You know what the results were, and now you're fitting your decisions to what gives you a favorable outcome. So that's one of the real things to watch out for when you're gathering your samples. It's very easy to come up with this hindsight bias where you peek at the data. Now, why did I throw out 30 to 50 or more cases of whatever you're testing? I'm no statistician, but what I do know is the more samples you have, the more confidence you can have. And it's all about confidence. Because let's say you flip a coin and you know it's a fair coin. So you know it's one side's heads and one side's tails. Let's say you flip it 10 times in a row and all 10 times come up heads. Does that mean it's a biased coin? I don't know. A lot of people might say so. Say, hey, what are the chances of it coming up 10 in a row? But as it said in the beginning, you know it's a fair coin, so that could still happen. So my guess is over the next 20, you probably will get some tails and it'll come back. It'll revert back to this mean. And that's why the more cases you have, the more the true nature of whatever you're looking at comes out. You can't really tell anything from one or two instances. Here's a great tragic example. Last week there were 3 major airplane crashes. There was the Algerian crash that was in Mali in Africa. There was the typhoon crash in Taiwan that was crashing when it was raining. And then there was the one shot down in the Ukraine by the missile. 3 times in 1 week. Let's just say that was your whole data sample. You take those 3 instances and you multiply it out times 52, you would conclude there's 156 airplane crashes a year. And you'd say, wow, I am not gonna be traveling if there's 3 crashes a week. There's no way I'm flying, forget it. So there's my point. You had limited data. You had 1 week worth of samples. You didn't take the previous year's worth where maybe, I don't know how many, maybe there were 6 crashes in the whole year. If you'd known that, you certainly would change that conclusion of the 156. And when you look at the statistics this is over millions of flights, the number of fatal accidents gets really low. So again, the more data you have, the better of a decision you can make, better conclusion you can reach, and the more accurate it's going to be. So that's just an easy way of saying you've got to use some statistics in what you're doing. Unfortunately, what a lot of people do, and I've fallen for it too, is you'll see 5 or 10 instances in a couple charts that you look at, and you will say, hey, boy, this looks great. This head and shoulders, and then there's this inverted hammer candlestick, and the market always reacts a certain way, or at least these 5 cases. So this is good. I'm going to go with it. Or you have a guru. Again, I'm talking about these gurus where they'll show you a couple specifically chosen instances that match what they want to say. Hey, look at when this higher high happens and then a lower low happens. Here's 5 cases where the market always did what I said. And they won't tell you about, if you looked at 100 of them, maybe 30 of them worked, and maybe it's a 30% hit rate rather than 100%. There actually was a trading book written a number of years ago on what was considered to be what the author said was a revolutionary position sizing method. And the whole book was based around it and showed example after example of trading systems that benefited from his method. And just by reading the book, if you knew nothing else, you would conclude that this is the holy grail of position sizing. This thing will take and quadruple or multiply by 10 my profits without increasing my drawdown. This is great. And you run to implement it, and then when you implement it, it doesn't work so good. Well, again, that's this limited data and drawn a conclusion. And what this author actually did was he created systems that benefited from his particular position sizing. The interesting part of the story, which most people don't know, and just to be fair, I'm not going to say who the author is or what the book is, but what this author did was he put this to use in real time in the markets, in a publicly traded, visible account. And he started out great, and I think tripled his money in a month or something using his method. And then still was using his position sizing method. Basically, like a month or 2 later, closed the account because it was very close to zero. So his method failed. Now, does that mean his method's bad? I wouldn't say that, but it certainly wasn't the holy grail that he was making it out to be. So the point is, the more data you get, the more chances that you're going to get the true nature of whatever you're looking at. And that's really the key. So, and again, you want confidence. And it really comes down to a statistical concept called hypothesis testing. And that is really dependent on the number of samples. And if you don't know what that is, I'm not going to be the one to tell you, because I am far from an expert in statistics. In my old job, well, I'll tell that story in a minute, but in my old job I had a statistician working for me, and there's kind of an interesting story with that. But the thing I recommend is you should, as a trader, whether you're doing algo trading, statistical, or discretionary trading, whatever, learn some basic stats, learn some basic probability theory, so that whatever you test, whatever you evaluate, you can draw some meaningful conclusions. And if you don't, you're going to come up with things like this, where, if you twist this statistics and analyze things wrong, you could come up with these crazy type conclusions. Kind of like, the good one was always that if I believe it was if in football, an NFL team, if an NFC team won the Super Bowl, then the stock market would go up that year, and if an AFC team won, maybe it was the other way around. One predicted the stock market. Well, all you're doing there, all the people are doing are taking some data and applying statistics incorrectly and drawing just a completely ridiculous conclusion. So my point is, that's why you should learn a little bit about statistics and probability. It'll help you out a ton as you're trying to evaluate things in testing. And, just as an example, let's say you had 30 samples of a candlestick pattern of something happening. And then after that candlestick, the market either goes up or down. So how many cases of those 30 do you think should show that they're profitable before you believe you have anything? 10, 20? Do all 30 of them have to be good? If you can't answer that, then that's kind of the reason you need to look at some of the statistics, because statistics can help you determine how many you need to feel comfortable that you have something more than just a random kind of occurrence. And that number would change if you had 50 samples. And that's kind of the interesting part of it, is as your number of samples go up, your confidence interval, or the probability of you being incorrect or your conclusion being wrong goes down. So again, this isn't intended to go through the statistics because it would probably put everybody to sleep, but it's important to kind of learn these things. And again, and the tough part about it is it can be very challenging, and it can also fool you, and you can also twist it to do whatever you want. So the story I was going to tell, when I was in the working world, I was in charge of quality assurance for an aerospace company, and so we made fuel pumps on aircraft. And basically, if the fuel pump stopped working, the engine would stop working, and it's hard to fly a plane without an engine. So you can see where that's going to head. But anyway, so it was a flight critical part, but I had some statisticians working for me. I was in charge of quality. And I remember one in particular, I wanted him to do some kind of analysis of a piece of factory machine equipment. And I told him what I wanted, and he came in, he thought about it, and then came back, and he asked me, he goes, well, what conclusion do you want to have? And I said, excuse me? He said, well, do you want to conclude that the machine is good, or do you want me to conclude that it's bad? He goes, I can do either one, and I can back either one up with results and statistics. You just have to tell me which one you want, and I'll do it. And I'm like, what? Hey, he's being a good employee doing what his boss wants, but I practically fainted because I didn't want the conclusion that I wanted. I wanted what the truth was. And that's the tricky part about statistics, is sometimes finding out what the truth is depends on how you analyze it. And again, I'm going back to, this is why you need to kind of educate yourself a little bit on how to do this type of statistics. And I'm not talking about any kind of real complicated type things in statistics. You can keep it pretty simple with some pretty standard, a t-test and those kind of things, and you can get some pretty good conclusions that are pretty much based in fact. So that's the thing to watch out for testing. All right, 2 more points, and then looks like we'll probably have a bunch of time for questions in the little quiz, if you guys are still awake, so hopefully everybody is. Next point is listen to the results. That's the next key. You have these trading room gurus, and again, I go to these gurus only because they're so often wrong, and that was one of my points I wanted to impress upon you. But you'll have these people saying, hey, I'm successful. When something happens in the market, you buy, you sell, listen to me. Okay. Well, let's say you go and you put this guru to the test, or you put this candlestick pattern to the test, or you put this moving average crossover to the test, and you find out it doesn't work, even though all the literature you read and all the things you heard says it does work. Well, if you know for certain you did it right and you get different results, what are you going to believe? Are you still going to believe, maybe a candlestick book that was written 50 years ago, or are you going to believe what the data is currently saying? You have to listen. You have to be willing to accept the results you have. And sometimes the results could tear apart your whole foundation of trading. And that's kind of the scary part. A lot of people don't want to know that they've invested so much time in a particular method only to find out it doesn't work. And they don't want to know that. But part of testing and part of the whole process is you got to listen to whatever it says, and you got to be ready to act on it and be ready to change what you're doing. Because I've come across people who swear up and down that a certain method works, that a certain person is infallible. There was one who was, you'd recognize the name if I told you it, but he had a free webinar, and he was doing this free webinar and the sound wasn't working. And I kept typing in the chat box, well, I did it once or twice, where I said, hey, the sound doesn't work. And immediately, like 5 or 10 people jumped on me and said, oh, just follow the slides. This guy's great. How dare you try to interrupt his thing by, getting on him about the sound. I'm like, whoa. It was at that point I realized that, we're just dealing with some infallible kind of person, and obviously he's got these disciples who you could probably tell these people, this guy could tell these people anything, and they'd lap it up, and they'd buy it. And the reality, the funny thing about him is he's been proven over and over again, because he was a CTA for a while, and so he had some public track records, that he'd lose people's money. Yet, so there's your test. Your test is multiple instances of this guy failing, and certain people just did not want to see the results and did not want to believe it. And there's a lot more to it than just a simple. I realize you can't see it as a simple test. Yes, no. Yes, it's right. No, it's wrong. There's a lot of emotions, a lot of psychology that gets involved. Where you've got this. I think it's called a cult of personality. It's who's the guy, Jim Jones, down in French Guiana or wherever that was, way back when he had all his followers commit suicide by drinking Kool-Aid, and that's where that phrase, drink the Kool-Aid, comes from. But it's true, some people don't want to give up their strongly held beliefs, even when they're shown evidence to the contrary. If Bigfoot showed up and they paraded him around in every city, and there'd still be people who refuse to believe there's Bigfoot, even if he was there, just because they'd refuse to believe the evidence. And vice versa. If somehow you could say there's definitely no Bigfoot, the people who believe in him are still going to believe. So as a trader, you can't do that. You can't act that way. You really have to just evaluate it and be unemotional and just go with whatever it says. I mean, I've certainly had trading systems that I've put a lot of time in, and a lot of effort, and a lot of emotional capital thinking about how good this system's going to be. And when it came down to it, the system didn't work. Some were algos, some were discretionary methods, and eventually at some point, if you're smart, you're going to say, you know what? The evidence is telling me this isn't working. I have to stop. And the people who get into trouble are the ones who refuse to believe it and say, oh, no, I just have to do a little tweak here and there, and then it'll work. So listen to the evidence. So, okay, so those are the keys. How can you employ these? How can you do it? How do you do this? Well, one of the key things, and this is if you're an algo trader, discretionary, or whatever, create what I'm calling a library. They can be entries, they can be exits, they can be position sizing methods, they can be whatever you want. It's a library. It's going to be these books, so to speak, in the library are going to be things you test and evaluate, and you're going to update and review them pretty often, because the conclusions might change over time. But you're going to have this more or less database or a library. Here's an example. So, I'd mentioned earlier this hanging man pattern and a trend line break pattern, and then the use of break-even stops. Now, this is just sample data. Don't go with this. This is just fake data I just put in there. But to show you an example of what I mean, let's say I look at the hanging man on the ES, on the TF, and on gold. And all I'm doing here is just saying, hey, when the hanging man shows up in ES, it is profitable 82% of the time. How do I define profit? That's not in this chart and stuff, but just some summary statistics of, this is good, this is bad. What it says here is probably in gold, break-even stops are probably not a good way to go. And again, this is just a sample. Don't use these numbers for anything. I should have wrote sample on it, but I forgot. These are just, it's just an idea, a concept of how you could create this library. And each one of these is your own little study that you've done, your own little book in your library. And so when you go to create your next discretionary system, you could say, well, I'm going to take a couple entries that I know work good and a couple exits and see if I can come up with something. Wow. There you go. Now you've come up with something that isn't just completely on a whim. It's something that's based on some actual hard data, and that's pretty cool. If you don't want to do it yourself, as I said, to really do it right, you have to know some statistics and stuff. There are some sources of reference material. For example, Edwards and Maggi, or Maggi, I'm not sure how to pronounce his name. Their classic book. It's got plenty of patterns and plenty of examples. And again, sometimes they probably cherry pick some of their examples and don't show you times it doesn't work. But that's a good basis for finding potential patterns that you could test. I'd mentioned that quote by that author who wrote that book before. There was another book he wrote with the same sort of title. But in this book, it was kind of interesting because he actually goes and looks at all these different candlestick patterns. And so there's an example over on the right of, he does an evening star pattern. So he goes in, like I said, he defines it and puts some rules around it, programs it, and then goes and tests it. And I guess he tested it here with some kind of on a portfolio of positions, which is really cool. It's even better than one market. And there's your equity curve. So, you'd have to look at it relative to other candlestick patterns, but again, this might help you, and if nothing else, seeing this kind of work would help you to think about how you could test whatever you're doing. And then one of the classics on candlestick pattern is Tom Bulkowski, and he has a whole bunch of books in his website. He has a website with all kinds of candlestick patterns and price patterns, and he goes in and defines it and then tests it and tells you, are these things good or bad? The amazing thing when I started looking at some of his things were some of the patterns that historically, that you read in little articles and stuff that, hey, this is a good pattern, this is a good pattern, this is a great candlestick. A lot of those things are the ones that tested the worst in what he did. Now maybe if you tested it a different way, you'd get some different results, but I thought it was interesting that, for the most part, it almost seemed like people were ignoring his facts and still reporting things that were incorrect. So maybe there's some opportunity there for you to see what he's doing and what he finds is good or bad. And again, the neat thing about this is you get to see how somebody else creates their library of patterns, and your library would be specific probably to what you're doing, and it would be different than what he's doing, but it'd be kind of a neat thing to do. So that's what I mean by doing a library. And really, when it comes down to it, the key, and again, I've said this a million times today, and it's probably not enough, is just test as much as possible. And I think it was Abe Lincoln that said if he had 8 hours to chop down a tree, he'd spend the first 6 hours sharpening his axe, and then the last 2 actually doing the chopping. Treat trading systems like that. If I was developing a discretionary system, I would spend the first 6 hours testing different things, and maybe the last 2 actually finalizing my approach and starting to trade it. So you want to test as much as you can. You can't have too many samples of something. The bad thing, and although it's really a good thing, is what you're going to find is when you do enough samples of almost every kind of standard pattern, is you'll find out that most of them are 50-50. A few years ago, I ran some algorithmic tests where I did moving average crossovers and some stochastic tests and maybe some RSI tests, and just tested those kind of entries. And what I found over a big enough number of cases, so like thousands of entries, is usually most of those entries were between like 49 and 51% profitable, meaning those entries weren't much better or any better, probably statistically they weren't any better than just flipping a coin. Kind of made me rethink things, kind of scared me a little bit, because I said, hey, this is what people think work, and they don't. It doesn't really work. Moving edge crossovers, whoa, that's kind of to test stuff and find out it doesn't work, kind of, again, kind of shakes you up a little bit and kind of can change the way you look at things. But I think it's always better to do it than not. All right, so we'll get to the quiz in a minute and the book giveaway, but first, maybe now's a good time for questions. If for some reason I don't get to your question or you have some follow-up questions, please just feel free to drop me an email. There's my email address. You can also post something. I have an Ask Me Anything thread over on Big Mike. You can also send me a private message. I love talking to other traders and helping other people out. So, feel free to get in touch with me if you want something answered. But what I'll do is I'll let Mike kind of sort through these questions and maybe take a minute or two, and then we'll start answering them.
Thanks, Kevin. All right, so we'll take some questions. You guys can go ahead and start typing those in now, and then when we're done with that, we'll give away the 5 books. While we're waiting for some questions to come in, I took a few notes myself. So one of the things that you said early on in the presentation was the importance of methodology versus overemphasis on psychology. You also mentioned journaling, and I wanted to just get your opinion for a moment, because I do realize that there are a large number of people, perhaps even the majority of people, that don't believe that psychology really has a place in trading, and they would say that methodology is everything and that it's really the only thing. I would say that there's a lot of psychology that actually comes into play into implementing any methodology. So no matter how you frame it, I mean, it's possible to frame it to where it looks as if psychology isn't taking a role, but really I think that it's inevitable, that you can't get away from it. So I think it's important for people to look at their actions, even from a 100% methodology-focused plan, and realize that maybe they're making some decisions based on a psychological response. And I think that journaling is actually a great way to discover those truths about yourself. You know, I don't mean a journal where it's just some statistical, you know, here's trade 1, here's trade 2, here's trade 3. That really isn't going to help anybody. It should be about the journey itself, you know. Why did you change something? Why did you implement this new idea? What was the result of the new idea? How did you test the new idea? You know, the process. Anything that you know, what's your opinion on all of that?
Well, I guess the reason I brought that up is because people lately, and you know, the last few years, it seems like people are talking more and more about psychology and how important it is. And the point I'm trying to make is, I don't want to say it's not important. You're right. It definitely is. Even for algorithmic traders, you know, some people think, hey, if I just trade with mechanical rules, there's no psychology. You're wrong. There is. There definitely is. But the point I was trying to make with all that is the way a lot of people, especially the people selling this psychology slant to it, is they make it sound like that's the key. And to me, that is wrong. The key is finding an edge, and you know, maybe there's some psychology that comes in finding an edge, but if you don't have an edge with your method, all the psychology in the world will not help you, and that's kind of my point. So let's just say you want to go do roulette, and you know roulette's a losing game. You know, mathematically, you will lose in the long run. All the psychology in the world will not help you. You know, whatever you do is not going to change the mathematics of it that you will lose in the long run.
Sure.
You might be able to somehow draw things out or something. I don't know, but you can't get away from the math, and that's my point. And the fear that I see with people relying too much on psychology is they think the psychology can replace a method. Now, that, you know, all the psychology in the world isn't going to make a bad method good. It can make a good method bad, certainly.
Right. That's kind of my point, is that you can have a stellar method, but if you have really piss poor way of implementing that method because of some type of psychological problem, like, you know, not wanting to have a losing day or whatever it is,
right,
then, you know, you're gonna. It doesn't matter how good the method is. Okay, I don't want to go too long. So here's another question I've got for you. Can you touch on introducing bias into your testing? You know, like, for example, right now we're in this really big bull market, and I see that a lot of people kind of unintentionally would introduce bias based on that. What are your thoughts on how to not do that, or how to test it out of a system?
Yeah, a lot of it, when you start looking at any kind of historical testing, you're going to have bias, and you can't get away from it. So, and I'll give you you gave a good example. I'll give you another one. Almost everybody is of the opinion that currencies trend better than other markets. Okay. So knowing that, when I go to create a currency system, even if I completely forget about that I knew that, deep down I know that currencies tend to trend pretty well. And there's a good fundamental reason for that, is because usually currencies are determined, their value by central banks, by interest rates, by decisions that politicians make, and a lot of times that moves slowly, and so that tends to produce some trends. And so the point is, once you know that, you can't unknow it, and when you go to develop a system in a currency, chances are, either subconsciously or not, you're going to be biased towards systems that are trend following. And those are the ones that are going to end up working because that's the way the market was. Well, let's just say tomorrow, somehow these world leaders get together and decide something where currencies are going to do something that's not trend following or that discourages trend following. Well, there goes your system, because you tested based on some kind of little bias, and now the market's fundamentally changed and your system will probably fail. But that's the kind of thing that happens. And so some of it is just anytime you do any kind of historical testing, you are going to introduce some kind of bias. It could be something like that. It could be you knew that the volatility was great in late 2008 and 2009 when the financial crisis was hitting. So maybe you design a system, discretionary or an algo type system, where you say, well, if the volatility gets above this much, I'm just stopping. Okay. Oh, and that just happens to eliminate
right.
that particular period of time. You know, and that happens all the time, and you got to constantly watch out for it, but sometimes you just can't avoid it, honestly.
So also you briefly mentioned something, and I wrote down on my notes, correlation is not causation. So, a lot of people will make an incorrect assumption just because something appears to be correlated, that there's a reason, the assumption they end up coming to is completely wrong and inaccurate, has no bearing, it's irrelevant. So how in your testing, how can you prove that this is actual useful correlation versus something that is totally not relevant, even though it does happen to be correlated for this particular set of data?
That's a really good question, and I think it's a lot of it. It's hard to answer because I'm sure I fall prey to it. So let's an example. You want to come up with a trading system based on phases of the moon. Okay, well, maybe the two are related. Maybe the moon phase causes some kind of reaction in human traders that turns into price action, and maybe you test and uncover something that is just completely unrelated. And again, I go back to the football example, and it appears that the moon influences prices. Sometimes you know it. Sometimes it's just so ridiculous that you can eliminate it, but a lot of times you can't. So, and that's where it's this gray area where you kind of take a chance and you say, well, I don't know if the moon really influences prices, but I have this system that says it does, so maybe it does, and you either decide to trade it or not. So I know that's not a very good answer, but a lot of times I don't think it's very clear on what's right and what's wrong.
Here's my last question, and then I'll start reading the other user questions. Can you talk about overfitting or curve fitting? So I guess there's different kinds of traders, right? There's traders that tend to work with daily bars. There's ones that tend to work with minute bars. There's ones that tend to work with really small time frames, like a range or a tick chart. And in each one of those, you can have a whole different set of circumstances. But one thing that's the truth in all of them is that it's quite easy to overfit or to curve fit. So you talked about the number of samples in order to be statistically relevant. So do you generally find that there's a blanket statement that more is better? Like if you have a number of samples that's 500, is it always better than a number of samples of 50? Or is there some point in which there's like a quality factor of those that comes into play?
Well, there's a couple parts to it. One, everything else being equal, I like to see more. I like to see more samples. But the problem you run into is more samples usually means more time, and then you might be kind of shooting yourself in the foot where maybe you've come up with a simple method, and the way the market's changed in the last, let's just say, 2-3 years, let's just say post-financial crisis. Okay, so that's 5 years. And you test over 5 years, and you don't get that many trades, and it looks good. But if you trade it over 15 years, you got a lot more samples, but now all of a sudden the system goes, just goes kaput. What do you believe? And a lot of times that is kind of a judgment call. If you think the one with less samples is better, just because maybe something fundamentally in the market changed and rendered all those other results
Right.
no good. That's a tough one too.
Okay, so I don't want to make this all about me, so I'll try to make this quick. Hang on, sorry.
Sounds like the dog has a question.
Yeah, timing is not good. Okay, so one thing that I tend to do personally is I prefer portfolio-based systems that trade more than one instrument. Okay, so let me just give you one hypothetical example of an easy way to increase the number of samples. Let's say that I want to trade a system that trades healthcare stocks. So
Right.
the sector of healthcare has a lot of tickers in it, and I can assume that there's some correlation in this sector. Okay,
Right.
isn't it? If you wrote a system that's good for one ticker in the healthcare world, and you applied it to 10 other tickers also of the healthcare sector, and it performed very poorly, this would be a major red flag to me. So I use this as kind of like a shortcut. I call it a shortcut. It seems like it's an easy thing to do for me, to just dramatically increase the number of samples without really increasing the time that you were talking about. What do you think? Is this good or bad?
Yeah, I mean, I think it's a good thing to do, and it's easier to do that kind of thing in stocks because, like you said, a particular industry, more or less, the stocks are going to react the same, and especially if you pick stocks with similar beta values. If the stocks are correlated to begin with, they should sort of act the same. What would concern me, let's just talk about futures, is if I had a system that worked super good with ES and just was the exact opposite with the NASDAQ or a TF. That would concern me. But if, let's just say it works reasonably well with another symbol, and just the first one I worked with works a lot better, I still might be willing to go with that. It doesn't. I guess I'm not of the opinion that if it works with one thing, it has to work with everything. But at the same time, there's this kind of fine line that it's got to work reasonably well with everything.
Right. All right. So Andrew asked the question, isn't context of a pattern at least as important as the pattern itself?
Could be, yep. And you got to ask yourself, can you define the context? And context could be, hey, it's a overall bear market, but today is a bull market day. Think about what you mean by context and see if you can define it. I think people confuse themselves or kind of trick themselves into sometimes context mattering and sometimes it not mattering. And what they'll do is, and I've seen discretionary traders beat themselves up, they will go back and look at previous trades that failed, and they'll say, oh, well, hey, this is why that failed. But then tomorrow the same thing could happen and the trade could work, and they'll never analyze it. So you got to try to define context is my point.
Ron, I believe, is pretty new, and so from that perspective, he's asking the question, would you recommend that he build a strategy in NinjaTrader or some other type of platform? He wants to do testing and automation.
There are a ton of good platforms. So Ninja's good, TradeStation's good. That's what I use. Multi-charts is good. The reason I use TradeStation is because back in 2004 or 5, whenever, I forget when, I think TradeStation, it definitely was the biggest. I don't even know if Ninja was around back then. It might have been. And so I just picked it and learned it. And the key is whatever you pick, you decide upon. There's pros and cons to all of them. Is just pick it and learn it and try to become more or less an expert at it. You know, and by expert I mean you should know what it can do good and what it can't do good, and you should also know how to trick it and how to give fraudulent results and how to give results that end up being real-time good systems. That's the key. So
Right.
I wouldn't necessarily recommend any kind of particular approach.
I don't know about TradeStation, but I see like a post pretty much every couple days on BMT about NinjaTrader, where they've come up with this system, and they're going to be retiring here, any minute, and it's almost always based on an exotic bar type, like a Renko-based bar, which you can't backtest correctly in Ninja. So like you said, it's important to know the gotchas.
Yep, and I'll tell you what. TradeStation's the same way. There's ways to fool it, and same thing. TradeStation forum, you'll see people saying, "Hey, I got this great strategy," and then people will come up and say, "No, it's bogus," and then inevitably people get mad.
Yeah, but one saving grace, which is probably true for TradeStation as well, is that if they would just spend one day, they've been working on this system for 2 weeks, adding filters and doing all this stuff to make it look great, but they never spent even one day testing it in the live market. And if they did, then they would see that the live results don't resemble the backtest results in any way.
Yep.
So,
and some of that's probably the money, and some of it's also this emotional attachment.
Yeah.
And you just can't be attached to whatever you do, because that's just a sure recipe for disaster.
So speaking of filters, Jeff is asking the question. He says, regarding historical bias, can it not be helpful in backtesting to show you filters that need to be added to avoid losing trades? So, I mean, let's talk about filters for a second, because I always see people that want to add filters to get rid of something, get rid of chop, get rid of this, get rid of that.
Yeah, and what you end up doing a lot of the time is you make a better back test, and that's it. That's where it ends. And you fool yourself into thinking, because I made a better back test, that means it's going to work better in the real world. And that's usually what filters do. They give you the false sense that something is better when it's really not going to be. Now, that being said, doesn't mean you can't do it. You just have to be very careful about it. And so I'll just give you an example of what I do. A couple of weeks ago, I was playing around with something with gold. 2 rules. And actually, this is the bot that's on the Battle of the Bot contest, and you can go and look at there in the thread. It's just 2 simple lines of code for the actual rules for the gold system. And what happened was I got pretty good results, and I just stopped there. Could I have done better? Oh, of course. I could have created a great back test. If I got that good as I did just doing 2 rules, if I added 3 more filters and stuff,
right,
I could have knocked it out of the park. But I don't think that would be necessarily a better system. I'd rather stick with the simplest system you can that meets your goals.
Yep, and I 1000% agree. Of having been doing systems for about 6 years now, 7 years. I started first with really complex systems, that had like a bajillion options and customizations and filters and, genetically optimize all the perfect values over, whatever. And that was 5 years ago. And now today it's the fewer rules, the better, and just apply it to a wider base of instruments. That's why I prefer the portfolio route. All right. So Byron is asking, or he has a comment. He says he has doubts about the validity of walk-forward testing, especially since it simply picks this month's optimum values and applies it to next month. Doesn't that simply make all of that out-of-sample data now part of your in-sample data?
if you were to run it multiple times, and let's say you in your example you do a month and then apply those values to the next month, and then you went back and tried it, well, let's try every 2 months of re-optimization. If you keep running your walk-forward testing, eventually out-of-sample becomes in-sample. But if you do it right, your out-of-sample actually stays out-of-sample because your optimization is done on a time period before the results you're tracking. And I'm probably not explaining it very well, but I think over on my website there's, or I'm sure if you search Big Mike's for walk forward, you'd find a chart that shows how you stitch together these out-of-sample periods, and it really is out-of-sample. It's certainly better than just regular back testing, and it's definitely not as good as real-time testing. That's kind of where I'd put it.
We should maybe mention that you've done several webinars on BMT, and a lot of them are more advanced on these types of particulars. So anybody that's wanting to learn more about that, you should check out the archives on BMT. Okay, yep. John is asking the question. He says, what do you think about the idea that trade management of the exit of the trade is more important than the entry of the trade?
I would say there's probably some validity to it. I mean, I think people are focused too much on entry, and what they end up doing is neglecting the exit. I think they're both important, and in the grand scheme of things, I think position sizing and money management is more important than either of those things. And to take it a step further, I think diversification of what you're doing is more important than all of those things. Entries and exits, I think people, especially entries, people focus on them because that's the thing they control. The market's got to do this, this, and this, and then I will enter. So if the market doesn't comply with my wishes, I'm staying out. You have that feeling of control. And exits, man, you're just at the mercy of the market, and that's why people, I think, focus on entries.
You just said something that I think is incredibly important, and that was diversification. So I personally believe that diversification, or trading a portfolio of systems, or however you want to phrase it, is the holy grail. I mean, it's the closest you can come to it.
I agree.
So I think that anyone that just has like one system in their back pocket and they're spending all their time and efforts, they really, really should consider expanding that to a basket of systems that they're looking at.
I'm just real quick, I'm a good example of that because, like I said, most of my trading is all this rule-based algo systems. But last year I stumbled across on Big Mike's this option selling method, and I started doing it because part of my thinking was this is something totally different than what I normally do, and it's going to be pretty uncorrelated result-wise. And I went with it, and I've been very happy with it. So it's just a diversification.
Yeah, I mean, from a statistical point of view, which is not my strong suit either, but I can read an Excel chart, and when you combine multiple systems together and you have less risk, less drawdown, it's magical. So it's really
Yeah, a lot of people don't talk about it, but I forget who won a Nobel Prize, I think, for bringing this up, but a lot of people don't like to talk about it, especially, I guess, people who are selling a trading system, because they don't want you to think that their trading system is nothing but the best.
So Scott has a question. He basically says, when do you determine that a system is not working anymore? And I know that you've covered, so I don't know, for anybody that doesn't know, Kevin has a thread on BMT called Taking a Trading System Live, where he's basically gone start to finish, or it's still in progress. And he's answered this type of question about 1 million times. But you want to give us an overview?
Well, there's a lot of different ways to do it. There probably is no one right way, one wrong way. There is no way I always do it. I change it up sometimes. The key is just coming up with something that you're going to say, hey, I'm going to quit trading the system when something happens, a drawdown, or whatever your criteria is. That, to me, is more the key, is coming up with whatever criteria you have, writing it down, and then living with it. I don't think two traders will do a whole lot different if one decides, hey, if I never have more than 3 losses in a row, if I have 6 losses in a row with the system, I'm stopping it because something's wrong. Over time, I think that trader would probably be just as good as somebody who said, I'm going to use max drawdown of a certain amount and then stop. So a lot of different ways to do it, and I think the key is just sticking to whatever you pick.
Right, which ultimately means consistency, right? Because it's like everything else, because if you're inconsistent on when you cut it off, then how are you going to know whether or not that was a good decision? How do you learn from it? How do you measure it if it's random, right?
Right.
All right, Scott asked the question, how do you determine where to place stops?
A lot of times, I guess it depends on the kind of system you're doing. Are you doing kind of like a trend following? Are you doing something that's more mean reversion related? Some of it's going to be your comfort level. Obviously, for most people, they're not going to want to do $5,000 per contract stops. But I bet if you tested it, most of the time, the systems that work the best, or if you tried different stop levels, a $5,000 stop is probably going to give you more profit in the long run. It might give you more pain as far as drawdown and intra-trade kind of things.
Right.
So, the key to figuring out where to put stops, a lot of it's depending on what your objectives with that particular system are and what you personally like and don't like. So I've never come across any kind of holy grail that says, support based on this is a great way to, great place to put the stop, and it, works terrific. There is no magic elixir that stops follow. It's kind of something you just have to test, and ultimately, I think, especially with stops, it's going to be something you feel comfortable with, because, like I said, most of the time it's having no stops is probably in the long run your best bet. But can you do that? Most people can't. I know most of the time I can't.
I think it's important to look at it as the whole equation of both risk and return or reward. Risk-adjusted return is a common way people phrase that. How much did you risk in order to make X? And then that can help you decide if that was a good decision or not. Obviously, if you risk $1 to make 10, that's better than risking $9 to make 10.
Right.
Hulk asked a question and said it was already answered, but I want to modify his original question just a little bit and simply ask, what do you think about systems that use multiple time frames of the instrument that it's trading in order to make decisions?
So I think what he means is you're creating one system and maybe you're using 2-minute, 5-minute, 10-minute bars to all factor in your decision.
Right.
I have one like that I run with the Euro currency. I think it uses 5 time frames, and it does calculations on each one to come up with your decision. I don't know if it's necessarily better or worse than any other system I have. It's just a different idea. There's nothing to say that just because something happens on a 1-minute, 5-minute, 15-minute bar that means it's always going to work. I think it's the same thing as with any other kind of trading idea. It may hold water, it may not, and it may not have anything to do with the fact that you're using multiple time frames. But again, it's something you can test and something you can find out for what you're doing if it works.
Instead of multiple time frames for the same instrument, Kevin, what do you think about looking at market breadth to make a decision? Whether it's tick or VIX or any number of, put call ratio stats, millions of them out there that you can look at. What do you think of looking at that versus a different time frame of the same instrument?
I think that if you can get the data and make sure the data you're seeing is good and up to date, and if you can test it, I think it's kind of cool to do. Like I have a system, I'm not trading it right now, but it was based on if Congress is in session or not. And
right.
There was actually a book somebody wrote on the whole thing that basically said when Congress is in session, you should be short stocks. Well, that hasn't really held up for the past, this past bull market leg, but again, it's another piece of data. But the tough part about bringing in outside data to whatever you're doing is you have to really take care to make sure that, especially when you test it historically, that you're not accidentally looking ahead with it, and that like if you use stock fundamental data, for example, that you're using it only after it was released. It's easy once something's in a database to mess up and accidentally have forward, you know what's going to happen in the future kind of thing, right, to do your systems. And that's what I always worry about with any kind of non-price and timestamp data. So,
well, yeah, okay. So I was thinking more traditional breadth indicators like advancing declining issues or just tick or volatility. But there's another. If you're trading bigger time frames, if you're looking at daily data, for example, or bigger, FRED, F-R-E-D, FRED. There's a really good source of free, I guess you could call it economic data, but it's basically a large database of statistical data like the Congress stuff or non-farm payrolls or any number that's reported more or less is here. And you can download it and you can stick it into like CSV format and chart it if you want.
Yep.
So I actually do that for some of my stuff, and it's kind of interesting playing with that.
Yeah, and so a lot of times with any kind of that non-price data, I think it all can be very useful, especially if you happen across something. So the put-call ratio, for example, if you find, you might be able to find that sometimes in certain cases it actually does sort of act as a predictor and kind of forecast where things are going. And boy, that's, if you can uncover stuff like that, that's pretty cool, because I can tell you probably 90% of people don't look at those kind of things, and
right,
you could have a nice sustainable edge there.
Right. Okay, so seeing how we're at 2 hours, I think we should do the books, and then I'll just say before we do the books, if there's anybody that had a question, that they're watching the recording and they have a question, or if they didn't get the question answered, Kevin's email address is on the screen, or also there's a thread on BMT. You can just do a search for Kevin Davey and you'll find threads where you can post questions. So before we give away the books, let me remind everybody that we're going to need your BMT username. That's how I'm going to get in touch with you after the webinar is over and get your address and get your autograph request. So have that ready, please. There's 5 books. You can only win once. The first person to answer correctly for book number 1 will win. The second person to answer correctly for book number 2 will win. By the time we're on book number 5, we're going to look for the 5th correct answer. And that way it doesn't matter how fast or slow you type. Everybody has a fair chance of winning. All right, Kevin, you got the questions. And then do you have the GoToWebinar answers window up so you can help me pick the answers?
Yes, I do. Let me open it up here.
Okay.
And by the way, for people who do have questions, if it's specific about the webinar, please just ask it in the webinar thread, because chances are if you had the question, other people will too, and so that'll make a nice kind of repository. And if it's just a general question, you can either put it on BMT or just send me an email. That'll probably be the easiest way. Okay, so let's see what we got here. So again, this is Wiley Finance. I just wanted to kind of give them a little plug, because they did donate these books, and they're pretty much the premier trading book company out there. Almost every really good selling book is by Wiley. So
Right.
that's the book you'll be getting, and let's move on to question number one. Question number one is going to be pretty easy, so you know, this should be if you don't get this one, the other ones just get tougher. Okay, what should every trader be doing that many do not do? And it's the main topic of this.
Okay.
Yeah, there we go.
All right. So we have
the answer was
answer.
testing.
Right. Okay. So
Okay.
Jeff M. I need your BMT username, please.
Okay, so that was good. So people were paying attention.
Oh yeah. All right.
I was worried that nobody would be.
No, they do pretty good when it comes to books.
All right.
Question 2.
Okay, so this is and Jeff actually typed in his name there. So.
Yeah, I got it.
Okay. So question 2, they get a little harder. Okay. What is the minimum number of samples you should gather for any test you run? Ah, there we go.
All right. So looking for the second person to answer correctly.
Yep, the first 2 are right. So.
Okay. Yeah, I was thinking that you would accept that. So Lawrence C. I need your BMT username, please. So the answer is, you want to say 30? 30 to 50?
Yeah, I mean, and 30 to 50 was what I mentioned a couple times. And again, the more the better, at least, you know, as far as statistics go.
Okay.
Okay, we're ready for question number 3. What is the bias? What's the name of the bias that occurs when you look at a chart and you pick a trade, but you already knew the outcome?
Looking for the third person to answer correctly.
There you go. Oh no, I'm sorry. No.
People are being, you know, they're purposely delaying their response so they can try to win.
Yeah.
Still waiting for the third correct answer.
Are you allowed to say how many you have already?
Yeah,
there
we
go.
We just got it. Okay, so Balaz J. Hope I didn't mess that up too bad. I need your BMT username, and Kevin, you want to give us the answer?
You know, it was. Well, before I give the answer, Balaz actually, I know he has a copy of the book.
Okay.
So,
how do you want to handle? It's up to you, man.
Boy, I don't know. Do you want to, Balaz? Do you want an autographed copy of it, or do you want something else of equal or greater value? Maybe I'll do that instead of sending him a book. And then that way he'll still be the winner. So, well, I'll handle that offline because he was the winner of that question. So I'll figure something out with him.
Okay.
But I know he has the book because he actually has been emailing me some.
Okay. And he just
said yes, he'd love an autographed copy. So
right.
There you go.
Okay.
Okay. Question 4. What is the branch of mathematics you should study to help you in evaluating any tests you conduct? There we go.
All right, so looking for the fourth correct answer. 1, 2, 3, 4. Is that Gautam V? Does that look right? Okay, so statistics was the answer, right?
Yep.
All right, so Gautam V, I hope I'm saying that close to correctly. I need your BMT username, please. Okay.
All right, and then we have one more. And this one, this one goes way back to the beginning of the talk. So this will be kind of interesting to see if people get this. Okay, what exciting thread on BMT should you be submitting a strategy or an algorithm for? I need the name of the thread.
All right, looking for the fifth one.
There we go.
All right, 1, 2,
yeah,
3,
first,
4,
second, third, yep.
So is that Andre B?
3, 4, yep.
Okay. So Andre, I need your BMT username, please. So the answer was Battle of the Bots.
Yep, and that's should be a pretty cool thing for anyone who's who's into some little contests and just watching how some algorithms perform. So,
absolutely, yeah. And thanks, Kevin, for helping us renew interest in that thread. I think that has a lot of potential.
Yeah, and you know, just to kind of give a shameless plug for it, we're going to be doing some cool things. Probably like the middle of August, I'm going to roll out some things where we're going to be kind of competing for a specific type of system. So it might be something like, hey, next month maybe we're going to give a special prize if you create a system that works with gold or works with natural gas, or something like that. We're going to be going through some different ideas, so it's going to be a good opportunity for people to try some different things and kind of push themselves. And the only downside to it is sometimes you fail, and everybody sees that, but that's the way you learn too, I think.
Right. I think it's important to share, and that everybody can get ideas from others, and that's the whole point.
Yep.
All right, guys. So congratulations to the guys that won the book. I'll be in touch with you in just a minute. So if you could stick near your computer so they could respond back to me right away, and that way I can get the information to Kevin. He'll autograph the books, and he'll mail them out to you. Since I'm in Ecuador, he will be taking care of that, and I appreciate it very much. I want to thank Kevin for his time today and the presentation and answering everybody's questions. And I'll see everybody on the forum. Thanks, Kevin.
All right. Thanks, Mike, and thanks, everyone, for attending.
All right. Bye.